So I guess where to start. So last night I was kind of digging into. I was trying to kind of like break down the trades that would occur for OPEX to happen via our theory and how that would apply to various deferrals through FINRA over. And I mean, this part of the year particularly is really annoying because you kind of have one deferral that runs into the next deferral that runs into the next deferral that runs into the next deferral, right? As we move from like Thanksgiving through Christmas and then the New Year. And so, there's a lot of opportunity for different parts of the settlement process to land in these windows and then get deferred out, right? And so I was wondering if we could find not only historical evidence of that occurring, but, historical evidence that fit within the framework of FINRA's regulations. And basically, the way the trade would break down is that, you have your APs and then they return cash to the ETFs. And then the ETFs rebalance and spend the cash buying equity in the markets, right? So the ETFs go out to the markets and they buy the equity. This appears very simple and straightforward. It's because for the most part it is, except this is actually three separate transactions, right? The AP is settling cash with an intermediary, and then you have a rebalance period that's a separate transaction where the ETF then deploys its capital in the markets, right? And I still contend that AP's cash settled on November 18th. This is when we saw XRT removed from Reg Show. The fails, ceased. Some of the ETFs rebalanced in this period, which gave GME a little bit of liquidity. It wasn't a lot. It was only like 2.27 million shares sold, but a little bit up into the December 16th expiration, right? And then since December 16th, we've seen APs, well, let's say short volatility funds, move their positioning from synthetic short to long volatility, right? Now, these positions profit on volatility to the downside as well, which we have seen some of. And what's interesting about that is that, they're shorting generally very hard every day. They're causing large fluctuations in price on the intraday, but they're not building up any new liquidity. They're basically just recycling the same liquidity every day, but instead of using it to churn volatility down, like we see pre-OPEX runs, we're seeing them use it to churn volatility up. Right, and so we're seeing hard shorts into the beginning of the day that are covered into the end of the day or covered into closing settlement. Now, yesterday we saw the shorts that they deployed in the early part of the day covered intraday. This doesn't happen every time, but it does when we see the rise into close, it does. The rest of the time, we're seeing those shorts covered at the closing auction, which means that the purchasing from those short covering is being internalized, and we're getting those really big prints of like 1.5 1.6 million shares at market close. You guys saw these over the last couple of weeks, and we can see that in the liquidity data, right? And if you look here at GME, and I pull this down to the 2-hour, and you look at this period of time from where they got that liquidity back going into. So here's the return of liquidity from the ETF sales. We see some liquidity returned up into the December 12th period right here. And then we see liquidity start to dry up again, right? But what we're really seeing is we're seeing the same, overall the trend is, less liquid, but we're seeing the same liquidity traded every day, back and forth. And the net effect is it driving the price down, right? Because we don't have as much buy pressure as we have short pressure. The market makers got a negative gamma hedge, so they're hedging down into, all of the downside movements without hedging the upside movement. But if you look here, you can see liquidity generated in the pre-market, which is then immediately used to short. And then if the covering begins during market hours, we see the price go up into the end of the day. Something we saw earlier in the day yesterday, right? But not all days have that same effect. If we go back a little further, we have, some days like this where, the covering doesn't really begin until we hit after market hours, right? And that's where we're getting those big end of day block orders. So keeping all of that in mind, I was trying to find some historical evidence of, GME's previous deferrals. Now in 2021, we didn't really have any holiday deferrals around the OPEX periods, right? And there's a big shift there between 2021 and 2022. In 2022, we start to see some things we didn't really see in 2021, right? We see our OPEX periods offset and less reliable. And we also see rising cost to borrow into two of our OPEX periods, but interestingly, not the August one. We actually see cost to borrow drop after August. And so I was trying to look for causes. And if you look at the OPEX periods for 2022, we have a lot of holidays that fall in the OPEX settlement period that we didn't have the previous year because, the dates shift. And we also didn't have rising cost to borrow in 2021, right? Cost to borrow rose with the Jan 2021 sneeze or squeeze or whatever you want to call it. And then after that, cost to borrow on GME went down like to 1%, sub 1% for basically the rest of the year, all the way into March of 2022. Now, the only reason for them to ever go to the lending pool would be desperation. It presents no advantage over shorting through purely ETFs. ETFs have infinite liquidity. ETFs have very easily resolvable FTDs. You can open up multiple CNS pipelines. And most importantly, when you short through ETFs, there's no recall risk. There is no long counterparty that's going to sell off their shares and recall your short position, right? And what's kind of important about that is, this year they've had to turn to the lending pool. And the question is why? If this is such a well-developed and thought-out system, the only reason for them, I think, to turn to the lending pool is because, their trades haven't settled with the ETFs, right? And they're stuck in a deferral the same as us, right? We see them positioning alongside us for long volatility. But that extra delay, that extra month or so that the deferral causes, leaves them without a secondary market for liquidity. And that forces them into the lending pool, which then raises the cost to borrow on GameStop, as we're seeing now, as we saw in May and March as well. I wanted to go back and look at a time period where we did have a lot of holidays during the deferral process. And so I went back to 2020, which was the last time, we might have experienced some of these same deferrals. If we look at the deferrals from December 25, 2020, the Christmas ones, you can see that December 21st was delayed to January 13th. Now, we've always thought that this first initial spike on GameStop that led into January OPEX was due to reg show, right? Due to the large amount of failures occurring on GME at the time and its high fail to volume ratio. But I think maybe what we saw, and this is kind of an experimental take, but a fresh way to look at it, maybe. We maybe saw November and December OPEXs deferred out into the same covering period as January OPEX, giving us kind of like a bigger OPEX, like a compounded one. And as you see on January 13th per FINRA 4210, we run, right? We have a significant amount of price improvement that then leads to further price improvement over the coming days into, the events of January 21st through 27th. But what's really important is if you look here at the liquidity on GameStop, and I think this might be an effect of the deferral process, we start to see GameStop go from illiquid, and we see it begin to return to mean, and then we see it become even more illiquid again. And then here on December 13th, we see it begin to run. And from December 13th through the end of the sneeze, GME's price action continues upwards. Now, if I go and look at the current period of deferrals, which is now our largest ETF, you can see that we moved from, very illiquid. We're much more illiquid now than we were back then. Some liquidity is resolved, and then we're moving back to an illiquid state once again. The other compelling part of this is it lines up perfectly with the deferral periods from Thanksgiving. This lines up perfectly with the deferral periods from Thanksgiving and then Christmas. If you look at this, November 18th is deferred to December 12th. That's the first crossover. And then December 20th, right here, oh, that's the 21st, sorry, is deferred to January 12th. Now, this isn't a double stamping, right, as Popcorn Trader so eloquently put it earlier. These are two separate trades. So you have a November 18th settlement of the AP, and then you have an ETF rebalance. So that settles out on the 12th, right? The ETFs, get their money, or they have their cash in escrow in order to buy back into their NAV. But the ETFs don't have to rebalance until the week after OPEX during their dividend period and the S&P rebalance, right? But the ETFs get a deferral here. And so this is actually a separate trade, which is now potentially deferred to January 12th, which would be, like right here. And so we're trying to corroborate the cost to borrow to see if, these deferred OPEXs inherently lead to a rise in cost to borrow. But I would say that right now, the volatility, volume, and liquidity all support this theory. And then as far as the DFV thing goes, DFV was an employee at Mass Mutual back in 2020, obviously before he quit his job once becoming a multimillionaire. But DFV was in a unique position to have access to the Rex deferral system. And so I thought, what would be really interesting is after noticing this, I wonder if DFV made any kind of indication at the time about the deferral process from December OPEX to early January. And in a stroke of pure tinfoil and imagination, I found that on January 13th, which it would have been the settlement day for FINRA's deferral in 2020, DFV retweeted the same tweet that his own tweet from the December OPEX T+2 period, which is really fucking compelling. He would have had access to the Rex codes, and he would have seen the deferral potentially in the system. So maybe not a time traveler, but maybe a slightly more informed investor. That's about it. That's what I got for you guys. How it's gonna play out, time will tell.